Now, we have looked at the concept of accruals back on the balance sheet, but we didn't really explain it. So let's take a moment and look at accruals. Accruals is a term in accounting that means to accumulate or build up. And we could accrue both on the asset side and the liability side of the balance sheet, but it's much more common on the liability side. And again, accruals are not negative, just like liabilities are not negative. They only refer to our obligations. A common entry you will see on balance sheets under accruals is holiday or vacation time. If an organization has a commitment to their employees that you will earn 1 day of vacation pay for every month you work during the year, then every month, at the end of the month, the company must calculate how many days of holiday or vacation pay have been earned, add that up on the accruals on the liability side as an obligation to be paid in the future. That's on what an accrual is. You will also see it under a variety of other situations. It basically means we are building up, adding up an obligation to be satisfied at a later period. Now, there's a lot of different links between the various financial statements, and we'll not only go through several of them in different modules, in some of the Excel models that we have built for you, that we will make available to you, you will clearly see the links. And that's one of the ways to understand the financials. It's one of the ways to verify that the financial statements you're looking at are accurate. So a quick look at the relationship between the balance sheet and the income statement. Look at the income statement for a moment. Our sales revenue is going to be shown. In many cases, some of the cash will come from our sales. Obviously, the net income that we didn't spend somewhere else will be in cash. Some of the sales that we have made won't be collected yet. So on the balance sheet, you'll see an accounts receivable. The cost of goods sold, and as we dive into the income statement, we'll get into this in more detail, is going to be directly related from the income statement back to the inventory account on the balance sheet, etc. So most of the line items on the income statement can be linked to the balance sheet, and several line items on the balance sheet can be linked to the cash flow statement. And as we'll see subsequently, the net income on the income statement, which if you'll notice is the last line on this slide on the right, is the first line to start the cash flow statement. So each of the three balance sheets, each of the three financial statements is linked to the other two. And once we understand how to link them, how to follow the links, we're in a very good position to understand whether the financial statements are accurate or not, number one. Number two, it makes it much easier to understand the financials when we see the links between them. So this is an Excel model that we have created for you. And you will see on the left is your opening balance sheet. And we have a particular date here. You can see the cash assets, non-cash. And you'll notice that the cash on the balance sheet that we open with is linked on the statement of cash flows to the beginning cash. Go down the rest of the balance sheet. You see your total assets, liabilities, common shares, retained earnings from the previous period. In this case, we do have treasury stock. This organization decided at some point, for any one of a number of reasons, to purchase back some of their shares. So we have our equity position, in this case, 23,530. We have our total liabilities and equity. Does the balance sheet balance? Total assets are 50,045. Total liabilities and equity, 50,045. Good. They do balance. And by the way, if you look below that, and you'll see in your Excel model, that's a cell with an if statement in there. It's actually a formula that goes into the liabilities and equity line, compares it to the asset line, and if they are the same, it'll tell you. It's a check cell. They in balance, and it's color-coded green. If those two don't balance, it'll turn red and it'll say out of balance. It's a quick way for you to make sure that just as you start analyzing the financial statements, the balance sheet actually balances. Okay, so here's the beginning of the time. Then we look at the income statement. The income statement shows our revenue, our expense, and our profit. So what you'll notice, starting at the top of the income statement, says for the year ending. So it tells us it's a 12-month statement. The net income is a positive number. So they had more revenue than they had expenses. Good. You'll notice that the net income, if you follow the arrow down to the statement of equity, which is not one of our typical financial statements, but we put it in here just to show you how to link these. We look at the previous retained earnings, which comes from the balance sheet, add in the net income. We show the payout of cash dividends, 429. So that's the company decision to take a portion of the net income and pay it out in cash to the common shareholders. Start with your retained earnings from last period, add in your net income, pay out or subtract your cash dividends. That will reconcile to your ending retained earnings. And if you follow the arrow, that's what proves on the ending balance sheet that our retained earnings is accurate. You look at the common shares on the opening balance sheet. Did we sell any new shares or retire any? Well, in this case, on the reconciliation down here, we show there was a small sale of shares, common shares at the end, that reconciles to our ending balance sheet. We look at the cash on the balance sheet, look at our statement of cash flows. You'll notice the three components. Operating cash flows were positive. Investing cash flows were negative. We used more cash than we created. And financing cash flows also show that we used more cash, paid out more than we created. Is this good or bad? Well, here's a key. When you're looking at the statement of cash flows, of the three components, you always want cash from operations to be positive. We generate more cash than we use. That's number one. Number two, we always want cash from operations to be the largest of the three. When you look at an organization's cash flow statement, and cash flow from operations is positive in consecutive periods, and it's the largest of the three numbers, you know that the organization is generating most of its cash from its main business. That's important. Investing cash flows show a negative. That means the company was buying new long-term assets, usually a good sign of growth. The financing cash flows show a use. So either that was repaying debt, paying cash dividends, or buying back shares. The increase in cash was 344. So linking back to the balance sheet, we had a beginning amount of cash. We added in the difference, 344 of new cash created from the organization during the year, gets us to our ending cash, which is then linked over to the balance sheet. As we said earlier, now we've proven the cash entry is right. That's one of the reasons that understanding the three different components, balance sheet, income statement, and cash flow statement, are so important. Understanding the links as demonstrated in the spreadsheet, are so important to understanding not only what each of the financial statements is telling us, but how they're linked together and your ability to follow the flow, to follow the transactions, to understand the organization, and to understand the financial statements are accurate is so important. So, do you need an advanced accounting or finance degree to understand the basic financial statements and what they tell us about an organization? Clearly, no. What the financial statements do for us is give us a clear picture of an organization. In the next module, we're going to take a deeper dive into the income statement and the cash flow statement, and you'll see where some of these components go even deeper. Until next time, this is Daniel Feynman.